All righty. Well, hello, everybody. Welcome to the first ever ElderAdo Financial Focus webinar. I know usually about 2 times a year, sometime in January and sometime in like September or October, we usually have a seminar for our clients. But with COVID and everything going on, we took the chance and decided to adopt a little bit of new technology with Zoom. So by now, since the lockdown, we've had lots of practice. So really excited you're here. We just want to thank you so much for joining us. Let me just introduce myself a little bit. I'm Daniel Carnes. I'm one of the financial advisors here at ElderAdo. And so real quick, just to kind of get some housekeeping things underway, on the bottom of your screen, if you move your mouse cursor to the very bottom, you'll see two buttons. There's a Q&A button and there's also a chat button. If you have any questions, feel free to ask those questions in one of those either two chat functions right there. You could also call or email us with some questions that you may have. One important thing I wanted to note, because of the time restriction we have, we won't be answering any questions today. Or at least live on this webinar. So if you have any questions, feel free to put them in the chat. You can call or email us and we'll be sure to have somebody follow up with you. So we just kind of showed you how Zoom works. And so let's go ahead and get right in. So this screen right here, if you can see, this is just a little disclosure we have. This webinar is for educational purposes only. Consult with a registered financial advisor, do your own due diligence, conduct your own research before making investment decisions. Please do not sue us. So moving on. So I'll be kind of giving a 2020 market recap as well as an economic update. And then my way better half is going to be going over some investing questions that matter today. And then we'll finish off with Jim. He'll be talking about the 2020 election. So stay tuned for that. So let's go ahead and get on started. To kind of get us up to speed to where we're at, we kind of have to understand a little bit where we came from. And so coming out of 2019, going into 2020, we were doing pretty well for ourselves. I mean, we had the lowest unemployment I think we've seen in decades, at as low as 3.5%. If you talk to economists 30, 40 years ago, they probably would have told you there's no way we get below 6%, but 3.5 is not bad. If you look at the CPI or the Consumer Price Index, we had low inflation. Gross domestic product or GDP, that's a measure of economic growth that we use to kind of see where the economy's at. That was all positive coming into 2020. Household income was up. We also had building permits and housing construction was up as well. And then the big kicker, if you can see the graph over to the top left, that's the S&P 500 index. That's just one of the main indexes we use to track what the market's doing. So in 2019, this S&P 500 was up over 30%. Average for the last 5, maybe 10, 15 years was about 10%. So that's pretty high. So again, like I said, we had a lot going on for us at the time. Really, the only concern that we had primarily was the election. And, I'll just kind of keep it at, election years, generally, you see an uptick in volatility just with all the uncertainty. I don't want to steal any of Jim's thunder, so stay tuned for his take on it. And so going into 2020, we heard about this thing called COVID. And, and really at the end of the day, the way that I like to preface it with clients is it was the boy who cried wolf. Well, why do I mean by that? So when a virus comes along, usually it will get some, big name headlines, cause a little bit of fear and uncertainty in the market, and then everything kind of goes back to its normal way. So, and I just kind of wanted to share some interesting numbers with you. According to the CDC, you can go to the CDC's website and find this. Since the year 2000, we've dealt with SARS. We've dealt with mumps, E. coli, bird flu, swine flu, MERS, Ebola, Zika, and now COVID-19. And, we've been through this before. I mean, since 2000, I mean, this is even a short list compared to all the other viruses that the CDC's website listed. So if you remember back in the early 2000s when we had SARS, I believe that if I remember correctly, the S&P 500 dipped about 12% when that was the main headline. And so going into this, it's like, okay, it's another virus. There'll be a little bit of freak out, and then, we'll kind of go on our merry way. And really the only thing that we were kind of expecting was, other than the fear factor of all that, we were expecting there to be a little bit of disruption from an economic standpoint with all the different supply chains, because you think about Apple and Nike and all these companies that do things like manufacturing out in China. So going into 2020 and this whole COVID thing, the craziest thing happened. We had a lockdown. Completely shut down the economy. And really, it was we were not expecting this, to be completely frank with you. There was just it was just so crazy. Like, wait a minute, we're shutting down the economy, all the flights and everything. And so basically, just to kind of give you, kind of what happens, in a very short amount of time, unemployment had skyrocketed as high as 14% into the double digits. Second quarter GDP took a massive hit, being down 33%. And the S&P 500, as a lot of you might remember, fell 35% from the market highs on February 19th of this year. Now, I kind of want to talk a little bit more about this and give a little bit of perspective. Remember 2008, the big mortgage crisis, and a little blip of time that we had almost 15 years ago. The S&P 500 index fell 55% in 17 months. Just take a moment and think about that. 55% in 17 months. During February and March of this year, the S&P 500 fell almost 2/3 of that in 24 trading days. That's a pretty strong, steep decline. And, Jim and I were looking at this and we're just like, this is not normal. Like, you compare an actual financial crisis to what we went through in March. This was nothing fundamental was about this. So, is that the end of the story? We crashed and fell and, fire and brimstone? No. Another crazy thing happened was the S&P 500, since the March 23rd bottom, started going up. And we were sitting there thinking, okay, it's kind of a dead cat bounce, as the old saying goes. Even a dead cat will bounce if dropped high enough. And so, we were thinking, well, the economy's down, unemployment's high, all these, economic numbers were coming out, and it's like, okay, it's going to get retested. And then the retail investors came in and started propping up the market, and it kept going up and kept going up and kept going up. And we're just kind of sitting there like, what in the world is happening here? Since the March 23rd bottom earlier this year, today, approximately, the S&P 500 is up 55%, which kind of blows my mind if you really think about it. So all the retail investors came back in, started propping up the market. So at the end of the day, there's a couple key takeaways that we really have to focus on here. Number one, no one can really predict the future. And number two, this is the reason why we do not sell in times of fear, in times of heavy volatility, when the markets are diving, like a really steep nosedive like we saw earlier this year. Just to tell you a story, unfortunately, we've had a couple clients. Jim and I have tried our best to say, hey, this is not the time to sell. This really isn't, it's really a bad idea to sell at the bottom. If anything, this is the time to buy. And they unfortunately could not handle the markets. We tried to talk them off the ledge and they just couldn't handle it. And so they sold out at the very bottom, which, if you look at the graph, 35% dip, you're buying everything at a 35% discount. And they unfortunately missed out on all these gains. So, which brings me to where we're at now. So far, the S&P 500 is up year to date. So from January 2nd, really, or January 1 to now, it's year to date, it's about up 9%. Unemployment has improved. We went from the very peak of 14%. Now we're down back to 8%. So still, still relatively high, but it's gotten a lot better. People are traveling more. So funny story, Jim and I actually flew to Denver to go visit some clients that we were originally going to visit in the spring, but COVID. So we got on the airplane and I was kind of surprised because we were packed in there and we all had the masks and everything, but that plane was pretty packed flying to Denver. So we're still waiting for the third quarter GDP numbers. I don't like to make predictions, but with everything that I'm seeing, I would not be surprised if, maybe we would still have negative GDP, but not to the extent of 33%. And then just one other kind of tidbit of information I thought was very interesting. According to the Federal Reserve Bank of New York, the total household debt is down for the first time since 2014. So I believe since COVID and everything that's been happening and people losing their jobs and trying to basically get by, what I think is that people are really going to take this experience to heart and start really kind of focusing on their financial health, paying off debt, have an emergency fund, things like that. So with everything being said, there is one major concern that we wanted to express to you. The stock market's up here. The economy is still down here, where they are usually in sync with one another. Now, I don't like making predictions. One of the things that we have been doing for our clients is really evaluating the investments we would recommend. And we would say, okay, if we have to go through another lockdown or another crash like we had in February, or if there's a correction in the market or anything really, what can we do to reduce risk? What can we do to reduce volatility and just try to get through this year? And there's a funny rule in the investing world. It's called the Noah rule. It's not when you predict rain, it's when you build the ark that counts. So that's what we've been doing for a lot of our clients. That's the main concern from a market and economic standpoint, is just that disconnect. So, Lord forbid, if there is a correction or, COVID numbers start to spike back up again, we just want to be ready for that. And the big reason why I'm mentioning this is that we still got 2.5 months left in the year. And, anything could happen at this point. So another big concern that we have for our clients, particularly our older clients, and even the concern that a lot of our older clients have brought up, is the ridiculously crazy low interest rates. It was last month that the Federal Reserve came out and announced that they forecast to keep the interest rates as low as zero for the next 2 to 3 years. And of course, a lot of our older clients have a big concern with that. It was earlier this year, I actually called a lot of the local banks, and just to get a quote for a 1-year CD, just to get an idea of what they're paying. A lot of them were paying 0.1%. The highest I was able to find was 0.5%, but that was at a credit union. So just to kind of give you an idea where the interest rates are at now, even the money market funds that we have available to us through TD Ameritrade, they're paying 0.01%. So just, 0.nothing is the joke. So one of the things that we've been doing, with the banks paying nothing and the CDs and the money markets, one alternative that we've been helping our clients with is taking that that extra cash that's earning basically nothing at the banks, and get the money into short-term bond funds. We try to figure out a way that our clients can earn a better interest rate without taking on a lot of risk. So this includes bond funds that invest in things like treasury bills or treasury notes, which are considered to be the safest investment out there. And then we also focus a lot on high quality corporate bonds. So you can think about companies that have a really good credit score. You might think of like Apple or Walmart or Amazon, the companies that are very unable to pay their debt. So that's it for me. I'm going to hand it over to my way better half, Jamie, and she's going to be going over some investing questions that matter today.
All right. Hey, everybody. I'm Jamie Carnes, and I'm a certified financial planner here at ElderAdo. And it's just wonderful to be able to spend some time with you today. And now that Daniel's kind of shared about how the economy is doing, how the market's been doing, I'm excited to kind of take all of that macro talk and bring it really down into how does that impact you and what does that mean for your investments and your finances. So I'm going to kind of share, some tips and some things to be doing today to make sure that you're set up for success. So the first thing I have right here is your portfolio diversified? Diversification is super important. As the old saying goes, don't put your eggs in one basket or your children all in one basket, as I have right there. And when you think about diversification, the biggest thing with diversification is it's all about mitigating risk. So there's kind of two big things that I think about when I think about diversification for your investments. The first one is, are you investing in single stocks or single bonds, or are you investing in a basket of those, like a mutual fund or an ETF? In terms of diversification, it's better to invest in a mutual fund and ETF for the reason that if one of those stocks tends to not do so well, then the rest of them kind of keep it up. So for example, say, you have a single stock investment in a cruise line and it goes bankrupt. Well, if you're invested in that, you have stock in that money is going to be gone. Whereas if you had that, share of that cruise stock in your basket of mutual funds, you have, maybe hundreds, maybe even thousands of other stocks or bonds that can help, prevent your portfolio from nosediving. So the biggest thing in terms of diversification is mutual funds and ETFs can help you be more diversified than a single stock. In terms of single stocks, if you're picking one and you think, oh, it's going to be, the best thing ever. Well, my question to you is, do you think that you're smarter than hundreds and thousands of investment analysts that get paid the big bucks to really rake in the money and choose the right stocks? Let's face it, you're probably not Warren Buffett. Otherwise, you'd be rolling in the dough. Another thing in terms of diversification, instead of single stocks versus mutual funds, is when you're investing in mutual funds or ETFs, you want to make sure that you're not just in stock funds or not just in bond funds. You want a little bit good mix across the board. So say that stocks tend to not do so good in a certain time, then you can have your bonds or your real estate, even your government securities that can help kind of uplift, and vice versa. And I'll talk a little bit more about asset allocation in a few minutes or so. But really, in terms of investing today, just make sure that you're diversified. You're not putting all your eggs in one basket and potentially losing your shirt if that one basket goes away. So the next investing question that matters today, especially in the world of COVID, is, do you have enough in cash reserves? Think about it. Is your job secure? If your job isn't secure, what are you going to do in terms of losing your money? So do you have enough money on hand to pay your bills if you happen to lose your job? And if so, how long are you going to be able to pay your bills for? So a good kind of rule of thumb in our industry is usually to have 3 to 6 months worth of expenses on hand. And in terms of that, it's really good to have 5 months of expenses in your bank account. The reason I say in your bank account or your savings account is because it's liquid. It's easy to get to if you need to. You don't have to sell any of your holdings to get to that. And then I would say take that one extra month and put that at home in cash. Say you're not able to get to the bank for whatever reason, you have a little bit of cash on hand to tide you through. And on this slide, there's some options when you do have that cash at home. You don't want to just leave it laying around. So there's a fireproof box you can use. There's even unique little safes that are kind of quote unquote burglar proof that are like a chicken noodle soup can that you can kind of hide it away, but it's also fireproof. So there's a lot of options out there, but make sure you have some cash reserves. I would also say, when you're thinking about cash reserves, 6 months of expenses, what does that really mean? I'm not saying, what are you spending when per month in expenses when you're working your job. I'm saying, what's the bare minimum that you need to get by in terms of expenses? What's going to pay your mortgage? What's going to pay for your utilities, your groceries, the necessities of life? I'm not talking about, what's going to pay for my travel here or kind of the luxury items. So think through that. And then another question that we've had a lot from quite a few clients recently is, should I pay off my mortgage or should I pay off my house? And in terms of that, yes, it can be a great tool to pay off your mortgage, not have that payment. But with the mortgage rates being so low recently, it's turning to be not the best idea all the time. Another thing that we look at in terms of should I pay off my house is, if you pay off your house and don't have that payment, wonderful, but are you going to have enough money to afford groceries? Because eating your house and eating bricks and stuff doesn't sound so great to me, probably not so great to you either. So make sure you have enough on hand in cash. Another question that really matters today, and Daniel alluded to it already with kind of how 2020 is gone, is, are you certain you're not going to panic sell even if your account happens to fall dramatically, 30 to 50%, somewhere in there? This year, the S&P 500 went down 35%. Now, I'm not saying that all of our clients' accounts went down 35%. Our clients are diversified across different asset classes, so it usually wasn't as steep as 35%, but this is a good example. So look at your investments, think through your emotions. Are you going to panic and sell if it falls? If that's the case, come in and talk to us. Let's see what we can do to make sure that your account is diversified enough and we have enough risk management in place to help you from panicking. Kind of in terms of an example, when the market went down in March, like Daniel said, it went, it went down about 35% right in here. So say at the very peak, you had 500,000 invested. And then after this went down, kind of down here at the trough at the end of March, you would have maybe, if you had panicked and sold out, you would have lost maybe $175,000. Seems like a lot, right? But if you had waited just a few extra months, even a few weeks, look at this recovery that's happening afterwards. That recovery happened in the months after that crash. And if you're looking at where your account is now, from that peak of 500,000, it's even up an extra 3 to 4% if you're all in the S&P. So this is just kind of a quick example of a good testament to, hey, stay for the long term. You'll get through it. Good example of that. The other investing question that matters today is all about, kind of related to the other one, is, did you buy and hold during the last credit crisis in 2008? Did you stick it through those long months of the markets going down like Daniel talked about, or did you sell out? But also, by that same token, if you stuck it through, do you realize that you're 12 years older than you were just since that last recession? So if you stuck it through, great, good job. I commend you. You made it through. But let's take a look at how you're doing because you're now 12 years older. Are you maybe closer towards retirement? A lot of people are, or maybe you're even in retirement. If you are, maybe we need to do some shifting of your assets. So maybe during the 2008 crisis, you were pretty heavy into the stocks and real estate and a little bit lighter on the bonds. That's okay, but maybe since you're 12 years older, maybe we want to shift it and we want to dial back a little that risk. Still make sure that you're earning enough, but dial it back. So maybe minimize some of those stocks, some of those more risky investments, bump up some of those bonds, just so that, like I said, your risk is a little bit minimized by doing some of that. But by the same token, maybe your assets are primarily in cash and bonds. Okay, yeah, the risk is minimized. However, like Daniel was saying, inflation or interest rates are really low, but inflation is still probably, 3 to 4% per year. So that means that in terms of your goods that you're buying, they're getting more and more expensive every year. And if your money's, in a savings account above that emergency fund, like I said, above that emergency fund amount, then your money essentially is staying flat and the cost is going up. So eventually your money is going to run out. So we want to make sure that we're hedging against that inflation cost. So these are some more questions. And then the last two questions I have that matter to you today is thinking of COVID and, people getting sick and potentially passing. Is your estate prepared and ready? And by that token, are you going to be okay if you pass away? Is your spouse going to be okay? And vice versa. Are you going to be okay if your spouse happens to pass away? There's some things that you need to do to get in place. Not a really fun thing to think about, but make sure you have them in place. For example, make sure you have a will set up and ready. You have some power of attorneys, financial or medical, to take care of things in case you become incapacitated and you can't make decisions for yourself. You also could set up a trust, and you definitely need to make sure you have beneficiaries on your accounts. If you don't set up beneficiaries, then you run the risk of the courts deciding who gets what. And you know a lot better on who should get what as opposed to the courts deciding who should get what in terms of your assets. Like I said, not a fun thing to think about, but it's an amazing gift that you would be giving those that you're leaving behind. So get hooked up with an attorney, get your estate plan ready. If you need help, we can help you find one and get you rolling in terms of that. And the last investing question I have that matters today before Jim gets to talking about the election is, should you buy gold? We have a lot of clients asking this question, and it's a valid question. In terms of buying gold, it's not a bad thing to purchase because it can help you further diversify your assets. But there's some things to think through if you're going to be buying gold. The first one is, are you going to buy a physical gold, or are you going to buy a kind of virtual mutual fund ETF that has gold assets within it? If you're going to buy the physical gold, you need to make sure it's getting appraised and that what you're paying is what it's worth. You need to make sure it's safely stored, so getting a fireproof box or something, or a safety deposit box, something that it's going to be safe. Make sure it's insured in case it gets stolen. Make sure that you're not paying crazy fees and commissions when you're buying it. And the other thing to think through when you're buying physical liquid gold or physical gold is that it's not a liquid asset. It's a little bit harder. You have to go take it somewhere to sell it. It's not as simple as, clicking a sell button if you're to have a mutual fund. The other things to consider with gold is it doesn't pay dividends. It's not a corporation that's earning profits. And the other thing, as you can see in this graph right here, is typically gold will do really well when there's a lot of fear, a lot of uncertainty with what's been going on, in the stock markets in the world. Obviously, that's pretty much 2020, right? So with 2020, you can see the price of gold has been going up dramatically. So if you're buying into gold, it's pretty high right now. So it's kind of like buying at the high. So it can be a pretty pricey investment for you. So these are just some investing questions that matter for you today. At the end of this, we'll have a little PDF we can send out to you with some key takeaways from Daniel's talk, from Jim's talk, and from mine. This one, I'll have a little questionnaire that you can kind of go through and take the questionnaire yourself and see how you're doing. If you'd like some extra insight after you go through that questionnaire and realize, hey, I could really use some help with diversification or asset allocation, whatnot, reach out to us and we're happy to help. But without further ado, we'll get to the election and what the 2020 election means for you.
Hello, this is Jim Elder, and we're going to talk about the upcoming election. We've been receiving a lot of phone calls from folks concerned about the election and what's the outcome, what's going to happen with their money as well. So let's go through this. Every 4 years, we get all what we call nervous Nelly investors that watch the news, watch the media, the commercials, and everything else going on TV, and are very concerned about what's going to happen with their money. And so our clients are calling us and asking these questions. So let's just go through this and let's just talk about investing in an election year. I've been investing on my own since 1973. I started when I was about 13 years old with my dad, and I had a newspaper route and we were buying investments. And so I was looking back and seeing how many elections I've been through when I've been investing, and I've been through 11 elections and I've survived every one of them. So this is not the end of the world, regardless of who wins the election. This election is very divisive. It's very contentious, and it's all over on things like social media and in the TV. So people are very worried about the outcome of the election. Let's the talk I'm going to share today, we're going to just show some things. We have about several items here I want to talk about here. Is number one, we'll talk about markets generally rise regardless of who's in charge in the White House. Election years can be more volatile. We'll talk about that. Investing in an election year can still be beneficial to your portfolio. Cashing out of your investments when you don't like the winner can be very detrimental. And then there's other factors that play a bigger role than just the election. So let's talk about the long-term effects here. This slide here just shows from way back in 1926 till today about how the markets have grown regardless of who's in the White House. We've had a few years during Nixon's era when we had a strong recession, and the Bush years, Bush Jr., that it didn't grow as well either then. But however, over the years, it doesn't really matter a whole lot about who's in charge. The other thing we want to talk about is the rate of return during election year. The blue bar here, you can see this is the average election year performance, and that has grown about 5.8% over many years. And but it's not as strong as a non-election year. A non-election year, the stock market has averaged about 9.6. But nevertheless, it doesn't matter. It still grows during election years. So don't try to time it and don't panic during these times. So just remember that the markets do grow, but not as strong as non-election years. The other bar here I want to talk about is how the markets do during election years and how they do the year after. The green bars, or the gray bars are showing the presidents that were in charge and how the performance happened during the election year. And then the green bars show what happens the year after. And again, besides a little bit back in the 70s, which is a little anomaly there, we really haven't had a difference there between an election year and the year that follows that. So again, remember not to focus too much on that. The next slide here is we're going to talk about volatility. There is more volatility during an election year. And why is that? It's because there's uncertainty. There's less visibility. And one thing the stock market does not like is uncertainty. That really does not like that. So once things clear up, the stock market gets happy with regardless of who wins the election, and the markets take off. And that's typical. So here you can see the blue chart, the blue bar here is the volatility during election year, swings up and down more, 15%, 15.8% compared to 15.2. So again, it's more volatile during election years. And so just keep that in mind. And then the other one here is, what is your political view? And this just shows on if there's a Republican president in charge, it shows that there's more optimistic views for Republicans, that they think that the economy is stronger. But however, the blue bar shows that if you're a Democrat, then if you have a Democrat in office, then they're more optimistic. So you can see during the Obama years, Democrats were more optimistic than Republicans. And more recently, Republicans were more optimistic under Trump than Democrats. So again, don't let your political views affect your portfolio. Try to stay as neutral as possible, regardless of what the news shows you. Okay, we're going to talk here of showing what the markets have done, annualized returns during this period. But the important thing to look at is there's many other factors that have to do with your portfolio than just who's in the office in the White House. Remember, Wall Street is in New York City, and that's when they talk about the stock market down Main Street is in New York City. And then Down the road is Washington, D.C. So the stock market, investments, companies, investors all tend to look at the companies. They worry about earnings and profitability and growth and jobs and producing items and providing services more than what's going on in Washington, D.C. Policies and tax reform and other things like that can affect the market return, but that's just a sideshow more than anything. So don't let what's happening in Washington, D.C. and this election affect the portfolio. So the markets are more concerned about the global economy, business cycles, and there's all these geopolitical situations going on. Those have as much or more effect than who's going to win this next election. This next one here just shows that if you invested back in 1938, $1,000, and you can see the blue bars are Democrat presidents and the red bars are Republican, you can see how this has just steadily grown up to $10 million in up to 2018. And so this just shows on how the markets will grow regardless of who's in office. So again, it's more on how you build your portfolio, asset allocation, rebalancing, than who's sitting in the Oval Office. So keep that in mind, and you can see the solid growth. We've had a few years, again, I mentioned before in the 70s, when we had Nixon, Ford, and Carter as president, that it didn't grow as much. But then we've had many other years, whether it's a Republican or Democrat president, that the markets have grown. The next slide I want to share with you is what the markets do after a president is elected. So what we want to show is the orange bars are stocks and the yellow are bonds. And so if we have a new president, the stock market, the year that the president wins, the stock market averages 9%. If we have a new president. If we have an incumbent president, then it grows 13.4. Remember what I said earlier, that the stock market does not like uncertainty. Well, when you have an incumbent, whether it's Republican or Democrat or independent, if they're an incumbent, then the markets already know pretty much how they're going to react. And so when you look at the previous presidents that we've had 2 terms, the markets have done better the second 4 years than the first 4 years because they know what to expect. And you can see this in this chart here. So again, incumbency just brings more certainty than a new president, a new administration. The other thing is clients are asking, what's our strategy? And Daniel, Jamie, and I, and Janet are working on strategies, and it's a moving target. And it's not just who wins the White House, but also who controls the Congress, because the House of Representatives controls the purse strings, and you need a working House, Senate, and a president for things to work. And so we have various scenarios. What if we have a Democrat president and a split Congress? Or what if we have a Republican president and a Democrat Congress, and so on? So we have various scenarios here. And what would we want to buy and what would we want to sell? So we have strategies, and we're working on those as we continue on. And if there's major changes, then those are things that we will be working on our portfolios, just so you know that. And so I just want to share with you that predicting the future is very hard, and don't try to do that at home on your own. But feel free to give us a call, talk to us. We can meet with you face to face, talk to you on the telephone, do a teleconference, whatever it takes to help you get through this situation. If you feel nervous about what's happening to your finances, please contact us and we'll help you. The world is a very complicated place. Things are very contentious nowadays, much more so than in the past. And so we are here to help you and sit down and come up with a good game plan. And remember that affecting your finances is not the same as affecting your investments. So make sure that you have a dichotomy there. And in final, I want to share with you something that I like to share with people. Remember, we can't control the election. So remember to act on things you can control and pray for things that you can't control. What can you control? You can control your portfolio, your investments, your debt, your budget. You can control those things. What can't you control? You can't control who's going to end up in Congress and who's going to end up in the White House. So focus on those things you can control, and your life would be a lot better, and you have a lot lower stress. So I want to thank you for joining us. And Oh yeah, thank you for joining us to our webinar. I'm not very good at technology here, and so feel free to give us a call at our office, and our phone numbers there on the screen, or give us a contact us by email, and we will be glad to help you out and assist you along the way. So thank you for attending.
And just one housekeeping, wanted to let you know, we'll send out that key takeaways document to all of you that are here, and we're recording this as well. So if you missed something and wanted to go back to something, we'll send that out to you so you can refer or send it out to anyone that needs it. Thanks again for your time.